In this video, we will be taking a basic look at the broad types of accounts that are available to us in the UK. Obviously, in this short video, I won't be able to discuss every single kind of account and all of the different variations, but there will be future videos going into more depth on what we talk about today and some things that I've left out. The types of accounts we will discuss here are basic accounts, current accounts, student accounts, joint bank accounts, savings accounts, and investment accounts. Basic accounts. These are specifically designed for people who do not qualify for a standard current account. This could be because of poor credit or no credit. You can have your salary or wages paid directly into this account. You have access to debit cards, in some cases this may just be a cash card, standing orders, and the access to cash machines. What you won't be able to do with a basic account is cash checks. Current account. A current account is what most people will be familiar with. These are used mainly to control and manage a person's day-to-day spending. Along with the features of a basic account, you are able to cash checks and you can use online banking to view and transfer your money. An overdraft is the biggest difference between basic accounts and current accounts, with an overdraft allowing you to spend more than you have in your own account, up to the agreed amount you have with your bank. Student account. A student account is simply a bank account aimed at those in higher education, with it offering incentives for students. An interest-free overdraft is commonplace and can be up to £3,000. It must be noted, however, that this isn't free money and must be paid back fully when you graduate. Freebie incentives are also common, with offers such as free rail cards, student discount cards, and National Express coach cards. Joint bank accounts. This is an account in which two or more people are named, and every person named on the account can pay money in or take money out. They are mostly used by married couples, civil partners, couples living together, or housemates who have shared expenses. The pros of this kind of account is that it is easier to share expenses and could possibly reduce arguments about money. However, the cons are that credit ratings will become linked. This could be a problem if you share the account with someone with a poor credit history. There could be a lack of privacy between the people sharing the account, and you could end up becoming responsible for somebody else's debt. Savings accounts. These are accounts in which you set up for money to be deposited into, on which you earn interest. There are many different types of savings accounts, such as easy access savings, from which you can withdraw your money whenever with no penalties. Regular savers accounts, in which you commit to paying in a certain amount each month and in return you are given a higher interest rate. And ISAs. ISA stands for Individual Savings Account. They act as a tax wrapper so that you can save your money without paying taxes on your savings or any interest or capital gains you make. Everyone is entitled to a £20,000 ISA allowance per year. This is as of 2020, though this can be changed year on year. There are 4 types of ISA you can choose from, these being a cash ISA, a stocks and shares ISA, a lifetime ISA or LISA, and an innovative finance ISA. Stocks and shares ISA. In this, you are able to invest in assets such as shares, funds, corporate bonds, government bonds and trusts. There is a £20,000 limit, but remember that this allowance includes any money you have already deposited in other types of ISA that same year. You don't pay any tax on the interest earned or the capital gains made, which is a huge benefit. The cost of holding the ISA will be dependent on the investment platform you are using. This is very important as fees will play a huge role in the overall performance of your investments. A SIPP. SIPP stands for Self-Invested Personal Pension. For the advantage of being able to manage your own fund, SIPPs tend to have higher charges than other types of pensions. You are able to access and use the money deposited into your SIPP from the age of 55. The benefits of a SIPP is that you get income tax relief on the money you pay in, and once you are of age, you can withdraw a 25% lump sum tax-free, and the rest will be taxed as income. This can be of great use, especially if you are currently paying tax as a higher rate taxpayer, because once retired, you will be in a lower tax bracket. There is a limit of £40,000 you can deposit into a SIPP per year. A general investment account. This is a way to hold investments outside of so-called tax wrappers. A general investment account is especially useful if you are wanting to invest a large amount of money in 1 year, though it is wise to take advantage of your ISA allowance before using a general investment account. You are able to hold and pay into as many general investment accounts as you want.